$57 a barrel is near the U.S. cost of production, break-even cost. But then compared to the last 20 years, during any time we've got lower in crude oil, with the exception of around 20, the U.S. was still a net importer. Now we're a net exporter, one of the largest exporters in the world, not just crude oil, ethanol, LNG, just massive energy excess production in this country. You have to export it, or we have a problem. And at the same time, we have seen declining demand from China, and the rest of the world's facing tariffs. So this is a perfect storm for a bear market. The question is just how low it goes. And like you said, you're paying less than $3 a gallon in New Jersey. I mean, I think it's just a matter of time it gets down to $2.
Oh, boy.
Oh, that would be nice.
Break out the hump.
Exactly. Have to ask you, there was a story in the terminal. Oil's long-awaited surplus arrives on billion-barrel flotilla. So more than 1 billion barrels amassed for the world's tanker fleet. What can you tell us about this?
Well, I enjoyed reading that article. It's just a sign of the cycle. The key thing to remember about the cycle is we're in the cycle towards a low price cure. That's just part of that excess supply coming on. We see potentially reduced supply out of U.S., reduced rig counts because prices are go lower. But it's the main reason we're down here is because of Russia's invasion of Ukraine, pumped up prices really high, and it incentivized this major shift. Now, over 60% of vehicle sales in China are now EVs, and it's kicked in, just efficiencies. Like my EV now is 11 years old. So what's happening now is how do we find the new low? So I think everything else is kind of just noise within this macro cycle. I think the macro cycle, bigger picture is, okay, if crude oil is down 20% in the year, that's on the year with the S&P 500 up almost 20%. Just imagine if we get a little bit of trickle down the S&P 500. So that's the problem. We're seeing deflationary forces from the world's most significant commodity, and we're seeing the stock market's still doing well. So to me, as I put my commodity trader hat on, I'm like, what I'm really worried about for the end of the year for crude oil to really accelerate this trend is if we just see a little back and fill in the stock market. And here, I'll end with one key statistic. On the year, gold is up 65%. Crude oil is down 20% or so. That disparity around 85% is the most in history going back 100 years. The most recent example is 2008 when the disparity was about 60%. Crude oil was down about 50% and gold was up close to 6 to 10%.
Mike, can we switch gears to another part of the commodity complex? That's soybeans. I'm seeing more and more reporting that, our great farmers out there, American farmers, that their silos are filling up with soybeans. What's going on there?
Yeah, right now, part it's in the middle of the trade war. The biggest issue in soybeans, it's very similar to crude oil. They're all in the same bucket, heading towards that lower price cure. They're going down because they went up so much in 2022. Incentivize that production. And the key thing about soybeans on a global basis is the massive supply that's coming out of Brazil, which is where the number one importer, China, is now importing. They're no longer importing any soybeans from the U.S., at least not in this harvest season. That's a big shift. So that's why I look at it. It's somewhat becoming a bit economic irrational because soybeans right now, because they're way past harvest in Brazil, on average are about 15% more than the average soybean in the U.S., yet China's still buying them, and they're pushing back, and I guess it's more pushing back in the U.S. So I wrote a story recently, U.S. soybeans might be able to pop if we get a little detente. Maybe China's come in and buy some of our soybeans. Maybe it'll get to $10 to $11 a bushel. Right now they're hovering around $10 a bushel, and the problem is the cost of production in this country is probably around $9.75. And so maybe we get a pop, but overall the risk is the prices still go lower, just like crude oil, and we have to get that low price cure, which oftentimes means pressure on the producers, unfortunately, which most of these cases are U.S. farmers.